Near zero interest rates in the U.S. and negative rates in Europe, plus trillions of dollars in aid, designed to set the stage for economic recovery. These measures could also ripen the ground for hordes of zombie companies. Now, yesterday, we talked about the economic risks these firms pose. Today, we look at how these walking dead of the business world are affecting or could affect the U.S. and Europe. Well, in the U.S., the Federal Reserve has pumped in trillions of dollars in monetary stimulus into the economy. And apart from cutting interest rates close to zero, the central bank stateside has been directly buying U.S. Treasuries and mortgage-backed securities for quite some time, a strategy known to many as quantitative easing, or QE. This was first used during the global financial crisis in 2008. But this time around is different because the Fed is also taking on more risks and it's started snapping up corporate bonds. With markets flush with liquidity and interest rates low, well, investors have been taking on bigger risks in the hunt for yield. And they've turned to one worrying place, unprofitable small cap companies. And this has been seen in the almost 80% rally in shares of unprofitable American small caps in the Russell 2000 index for the first 4 months since the bottom that the markets hit in March. Now, during the same period, the share prices of profitable companies in the index rose only 47%. Now, this could mean that investors are plonking money in zombie companies. And there are many of them. The number of zombie companies in the U.S. has risen over the years to almost 20% of all listed companies this year. This is according to Deutsche Bank analysis. Compare that to 5% in 2008 when the GFC first started. So you can see a steady climb there. Now, in Europe, we're seeing more potential for zombie companies as well. The European Central Bank, for one, has pledged a stimulus program worth about 1.59 trillion US dollars, which is about 1.35 trillion euros. And they, too, are buying up government bonds. Now, key interest rates have been negative there since 2016. Now, in Germany alone, the Eurozone's biggest economy, zombie companies were almost unheard of in 1990, but they steadily rose to comprise 7.5% of all listed firms in 2008 during the global financial crisis, and that number has crept up. In fact, almost doubled to, has doubled to 15% now, according to Deutsche Bank. That's just 4 percentage points lower than the United States. And it's a similar story in France as well. Zombie companies started popping up from the early 1990s to make up 17% of all listed firms this year, according to Deutsche Bank. Right, for more analysis on zombie companies and the effects across Europe and the US, we're joined by Jack McIntyre, portfolio manager of Brandywine Global, and he speaks to us live from Philadelphia. Jack, great pleasure to have you join us today. I'm not sure if you got to see those graphs that I just showed to our viewers, but they looked at the percentage of zombie companies of all listed firms across Europe and also in the United States. You know what struck me as really interesting is not where we came from 2008, but the fact that we've seen a steady rise in the number of zombie companies, and that was before the pandemic.
So it's actually not that surprising because we've had manipulated markets for over a decade. As you correctly pointed out, the seeds were planted after the GFC. And this is just another more accelerated version of that. I think it's interesting, though, because zombie companies actually do serve a role, particularly for bond investors. I mean, they actually help keep inflation low, because they are a competitor that under normal times wouldn't exist. So the strong companies just don't have pricing power. So it creates an overall lower level of inflation that would otherwise persist. That's only important in the sense that it allows the monetary authorities in the US and Europe to continue to run stimulative monetary policy to try and get these economies to grow a little bit faster. We haven't had much luck, but so zombie companies do serve a role.
Well, it's interesting that you point that out, because if that's the case, and we've seen the steady rise from the global financial crisis, which we thought it was diabolical, to what we're facing today, that number is surely going to skyrocket from this point onwards, given the COVID-19 pandemic, and therefore we will never see inflation.
You're right, up until the point that for whatever reason, the monetary authorities, the Fed, the ECB in particular, start to pull back on monetary stimulus and rates move higher. We're not there yet. There seems to be a big commitment by the central banks to maintain low rates for longer under this environment. And as we all know, there's a huge amount of capital. I mean, the central bank policy is punishing savers. So savers are doing what they would normally do. They're trying to reach for yield. That's okay for now. It's not going to end well, but it might not end well for 5 years.
So zombie companies exist largely because financial markets allow them to exist, but actually it's really because the central banks allow them to exist, right?
Exactly, that is true. And I would also, though, say the politicians. I mean, this is inherently an issue with democracies. Politicians, you know, they're all about self-preservation, self-interest over ideologue. They want to get reelected. They need the populace to be employed because that populace is the electorate. They vote. So it's actually sort of a double-pronged. Central banks certainly hold some responsibility, but I would actually say the governments, politicians do as well. They struggle to go through this concept of creative destruction, which ultimately will be necessary if we're really going to get any really strong growth coming out of this pandemic.
Well, Jack, if you I'll take you back to those graphs that according to Deutsche Bank analysis, that showed the growth from 2008 to 2019 in terms of zombie companies. Explain to me this. What does it say when we've seen an exponential rise in zombie companies in the U.S. compared to Europe? Because the numbers are actually quite stark. It seems to be a worse situation in the U.S. So does that mean it's not as much of a moral hazard there?
I'd say that, no, there's definitely some moral hazard across the board. And you know, the Fed has been sort of extra aggressive going down this path. You know, they've done the policies that they did post-GFC, but they've done magnitudes more with the Fed sort of getting involved in the corporate bond market. It provides a backstop. I mean, I kind of have this view that investment-grade corporate bonds are similar to treasuries, not that there's an explicit guarantee, but there's a backstop, an artificial backstop by conceivably the world's most important central bank. So it's causing investors such as ourselves to want to go out there and invest in those types of bonds in the pursuit of additional yield. So yeah, there's moral hazard all across the board here.
Well, Jack, is the opportunities or investing opportunities only singled out in the corporate bond market, or are there also opportunities in the equity space? Because if you take a look at, you know, where money flows have gone, a lot of small cap companies in the U.S. have benefited tremendously compared to the more profitable ones as well. And what is the danger for investors out there in looking at either asset classes, be it corporate bonds or equities, when looking at zombie companies as investment opportunities?
Yeah, so on the corporate bond side, I mean, there is a backstop by and large. When you go down the equity path, you know, clearly you're going down the capital structure, so it's riskier. It's fine as long as things continue at this pace. We just don't know when this is going to end. You know, you don't want to be the last man standing. But I think we've got a window here where these zombie companies will continue to I don't want to say thrive, but survive. Because what is a zombie company? It's inherently companies that can't generate enough cash flow to cover their interest expense, but yet the market's willing to buy their debt for now. And that means that if we get better growth, then maybe there's a chance these companies might start to fire on all cylinders and survive and prosper. But, you know, that's clearly a risk borne by equity investors.
Sounds like it, Jack. I really appreciate your time today to discuss the prospects of zombie company opportunities out there. That was Jack McIntyre, Portfolio Manager at Brandywine Global.